Now we will solve some MCQs. Ready? Question number 1 quiz. A commodity that is traded on an authorized commodity exchange. Option A is a movable article having value. Option B is something which is bought or sold. Is one which is produced or used as a subject of barter or sale. And D, all of these. Which is the most appropriate answer? A, B, C, D. All of these. It's a movable article having value. Is which is something which is bought or sold and which is subject of barter or sale. So all three answers are right. So tick tick all of these. Okay, now second question. A commodity future contract is, read and tell me, an agreement to buy or sell a specific type and grade of a commodity, deliverable at a specific time in future at an agreed upon place, an agreement settled at a market determined price, and point number D, all of these. B, D, D. Is it an agreement to buy or sell a specific type and grade of commodity? Yes. Is it deliverable at a specific time in future at an agreed upon place? Yes. Is it an agreement settled at a market determined price? Yes. Yes. Afterwards, whatever will be the market price, at that time it will be settled. Difference will be treated as gain or loss. Difference is treated as a gain or loss. So it will be settled at a market determined price on maturity. Tick tick. All of these. The three basic type of participant in the commodity market are hedger, arbitrator, speculator, or B, all three. All three? Right. Hedger, speculator, arbitrator. The national level multi commodity exchanges are is or are NCDX, MCX, National Multi Commodity Exchange, NMC. All of these. Which is the right answer? All these three are multi commodity exchange, national level. All of these. Commodity market in India is regulated by, sorry, answer has already come. This is now SEBI. Government of India, yes. SEBI, yes, and respective commodity also. So the answer will become all of these. One more chance. Now I will not show you the answer. Commodity futures are different from that of a financial future in the sense that commodity future may involve cost of storage, a financial future may not. Commodity future may involve insurance, a financial future may not. Financial future may involve financial return, a commodity future may not. All of these. Which is the correct answer? D. Because commodity involves storage, but financial future may not. Commodity future involve insurance, financial future may not. And in case of financial future, there are financial returns, interest and dividend. Commodity future may not. All of. One more last chance. Agricultural producers predominantly use the commodity exchange market to dash the potential cost of commodity price volatility. Speculate, arbitrage, hedge, all of these. You will say all previous answers were all of these. So this time also it should be all of this. Yes or no? No. Agricultural producers want to hedge the price volatility risk. So here the fill in the blanks, hedge. This type of questions are expected in the exam. So far they have not asked. Now write in the notebook one concept called hedge ratio in the notebook. Hedge ratio. Because in your study material, there is a question on hedge ratio. So, what is hedge ratio in the context of commodity future? So, first you write down and then I will explain and will solve one example. Hedge ratio helps us to calculate. Hedge ratio helps us to calculate. First you write, then I will explain. Hedge ratio helps us to calculate the value of future contract to be sold. The value of future contract to be sold against the existing position. Against the existing position to minimize risk. To minimize risk of the entire position of cash and future. To minimize risk of the entire position of cash and future. First we write. Then next line at hedge ratio is defined as the number of future position. The number of future position divided by the cash market position. Number of future position divided by the cash market position. And third line write down hedge ratio chosen should provide us total minimum risk. Hedge ratio chosen should provide us total minimum risk. Hedge ratio chosen should provide us total minimum risk. So what is the meaning of hedge ratio? If suppose you have a position in the cash market, let us say you are holding gold, you purchase gold, so there is a risk. You want to sell this gold after 3 months or after some time. Risk is that the price may fall. So hedge ratio tells us what is the position required in the future market. What is the position required in the future market to minimize the risk. That means my net loss will be minimum or negligible. So how many quantity of future you should buy or sell? If you have a long position in gold, then one thing is that you will take a short position in future. Okay, but then question is quantity. Question is quantity. So now we will learn after this the formula of hedge ratio, which will tell you the quantity that you need to buy or sell to minimize the risk, so that your loss in one will be compensated by the gain in the other one. So your net loss will be negligible or very small. That is hedge ratio. Okay. That is my risk of entire position of cash and future will be minimized. Hedge ratio should provide us total minimum risk. One formula is mentioned here also. Hedge ratio is the number of units, number of future position divided by cash market position. Okay. So first we'll write the formula. We'll see the logic of that formula and then we'll take the example. So right now hedge ratio means what position is required in the future market to have a minimum risk in the cash and future market. To protect your position in the cash market, what position is required? how many units of future contract is required to minimize the risk. According to data given, you will do the calculation. First formula is hedge ratio equal to future position upon cash market position. Future position upon cash market position. But the question which they have asked in the exam is based on the second formula, hedge ratio equal to correlation between spot price and future price. Correlation, what you have heard in portfolio chapter, into standard deviation of spot price, into standard deviation of spot price. That is, what is the standard deviation of spot price? How the spot price changes, the standard deviation. So far in the exam, this is always given to you. You just have to apply the formula upon standard deviation of future price. Now then your question will be how to derive the formula. Don't derive. Because to derive that formula, you have to go back to your old mathematics days. In your 12th standard maths or CPT or foundation maths, there was a derivative and integration concept. Using those mathematical concept of derivative and integration, the formula has been derived. So that means by looking at the formula, you can't really take the meaning out of it. It has been derived after undergoing few mathematical steps. Okay. Only what we will do, we'll learn the interpretation of this hedge ratio. How do you interpret this hedge ratio? Suppose this answer comes to 0.5, 0.7, something like that. So how do you interpret this? Hedge ratio indicates that for every 1% increase in future price or 1% change in future price, for every 1% change in future price, the spot price are likely to increase by a percentage equal to hedge ratio. For every 1% change in the future price, the spot price is likely to change by a percentage equal to hedge ratio. Now suppose your answer is 0.5, means if future prices changes by 1%, the spot prices changes by 0.5%. This concept of hedge ratio, right, one more line, the concept of hedge ratio, that is the term used in future market, is based on the concept of beta. Now do you remember the formula of beta? R means correlation into standard deviation of the stock upon standard deviation of the market. And how do you interpret beta? 1% change in market will produce a change in the stock price equal to its beta. So if beta is 1.5, it means 1% change in market price will produce 1.5% change in the share price. So here in this context of commodity derivative, beta or hedge ratio means 1% change in future price will produce so much percentage change in the spot price, that is equal to hedge ratio. Now in order to understand the concept better and prove this concept, we will take one small example. This is the routine question they ask on this topic, if at all they ask. Okay. So right, the standard deviation of the monthly spot price of gold is 0.90. The standard deviation of the monthly spot price of gold is 0.90. It will be given to you in the exam. For exam point of view, Otherwise, you know how to compute standard deviation, taught in your portfolio chapter. The standard deviation of the monthly future prices of gold is 1.20. Coefficient of correlation. Coefficient of correlation between these two prices is 0.60. Coefficient of correlation between these two prices is 0.60. Today is today is 20th February 2010. Today is 20th February 2010. An exporter jeweler has to purchase an exporter jeweler has to purchase 100 kgs of gold after 1 month. An exporter jeweler has to purchase 100 kgs of gold after 1 month. Gold future contract mature on Gold future contract mature on 20th of every month. Gold future contract mature on 20th of every month. How can it be hedged against? How can it be hedged against rise in gold prices? How can it be hedged against rise in gold prices? One more line, right? Prove. Prove. What is the standard deviation of spot price? 0.90. Standard deviation of future is 1.2. Correlation 0.6. An exporter jeweler has to purchase 100 kgs of gold after 1 month. So he has to buy gold after 1 month. What is the risk? Price may rise. Suppose you are going to get married after 1 month, example, and you want to wear a lot of gold, more than Priyanka Chopra and Deepika combined together. Okay, you want to wear 100 kgs of gold, for example, but you are worried that the price of gold may rise. So, what position in the future market you will take? First, you tell me what position you will take. You will buy future or sell future? Hmm? Buy future or sell future? Then we'll decide the quantity. Buy future, so that if the price of the gold rises and if you bought future, there is a gain in the future, but there will be a loss in actual physical purchase of gold. So, gain in future will compensate the loss in the actual increase in the value of gold after a month, right? But the decline, there will be loss in future, but gain in the actual purchase of gold. So, first answer is we will purchase future on gold, but then the quantity. Okay, so write down how to calculate the quantity. For that, first I need to calculate the hedge ratio, and then hedge ratio multiplied by the cash position will give me future position, and then I'm going to see whether this ratio really works or not. So write down hedge ratio equal to R into, what is R? Correlation. R correlation into SD, standard deviation of spot price, SDS, upon SDF, standard deviation of future price. All three numbers are supplied to you. Multiply 0.60 into 0.90 divided by 1.20. Answer 0.45. Hedge ratio is 0.45, indicating for 1% change in the future price, the underlying asset value changes by 0.45%. Okay. Then next heading, write down step 2, calculation of number of kgs of future contract to be bought. Calculation of number of kgs of future contract to be bought. Right hand side quantity. In the exam you have to answer up to quantity. Proof you will write only if they ask you. Otherwise no need to prove your answer. So what is the spot position in kgs? 100. Hedge ratio 0.45. So multiply 100 into 0.45. Point C. Future position required in kgs. Future position required in kgs. Future position required in kgs A into B 45 kgs. Like we used to do in the derivative chapter also. Beta multiplied by cash position. Okay. When the question was what position in the Nifty future you will take, spot position into beta. Is it right? In derivative chapter in group 1, using Nifty future, how will you hedge? So it was the position in the cash market into the beta with respect to Nifty. Now I am going to write proof how this answer is right. Let us assume that the spot price is rupees 16 lakh per kg. Let us assume that the spot price is rupees 16 lakh per kg and future price is rupees 16 lakh 100 per kg. Rupees 16 lakh 100 per kg. They may not be equal at given point of time today. Let us assume that future price rise by 10%. So now you tell me what will be the change in the spot price. Let us assume future price rise by 10%. So what will be the change in the spot price? Multiply by hedge ratio. So right now spot prices are expected to rise by hedge ratio into 10%. Hedge ratio is 0.45. How much is that? 4.5%. Now we'll see what will be the gain in future and what will be the loss in the spot market. Since you have bought future, it has gone up by 10%, you'll gain. But the price of gold will rise, so in the spot market you would lose. Loss should be compensated by gain. Loss should be compensated by gain. So next heading, write down calculation of net gain or net loss. Calculation of net gain or net loss. Calculation of net gain or net loss. Serial number, particulars, rupees. First write down loss on spot position. Loss on spot position due to price increase. Loss on spot position due to price increase. because you are going to buy at 16 lakh, it has increased by 4.5% per kg into 100 kgs. So you would have suffered a loss of 72 lakh. Had you not taken the position in the future market, you would have suffered a loss of 72 lakh. But you'll have a gain also. You have a long position in future. You have bought future. Buyer of the future makes profit if the price rises. So gain in future market, same thing, 16 lakh 100 into 10% into 45 kgs. So that comes to roughly 72 lakh 450. Net gain 450, almost negligible. The one who buys 100 kgs of gold, for them 450 rupees is a big amount or a small amount? Very small. Tax also he has to. My God, you are definitely CS2. Even in your dream, you must be thinking of tax only. Part 1 of this chapter was institutions. Part 2 is intermediaries. Name of the chapter is institutions and intermediaries. So we have discussed many types of institutions. Okay, banks, stock exchanges. Okay, commodity exchanges, metal exchanges. Now we'll discuss intermediary. These are the people who facilitate the transaction. They are more like service providers. They are required for smooth functioning of the capital market, money market, financial markets. They bring the savers and investors together. They provide lot of administrative services, technical services, legal services. Ordinary investor may not know how to execute the trade. Ordinary businessman may not know how to raise funds from the share market. So here comes the role of these different types of intermediaries. So who are the intermediaries we are going to cover in this chapter? Merchant banker, registrar to an issue, share transfer agent, underwriter, banker, debenture trustee, portfolio manager, stock broker, and under the stock broker, his agent called sub broker. So first, in next 15 minutes, we'll cover this intermediaries. Merchant banker. Did we come across merchant banker earlier also? You will find a lot of repetitions in your syllabus, but it's okay. So these are the people who help the company in raising the funds. Okay, because a lot of compliances are involved. Legal compliances, documentation, negotiations, valuation. You are a businessman. You don't know all these technicalities. Don't worry. Go to merchant banker. They will do everything on your behalf. Of course, they will charge you some fees, but it's okay. So, what SEBI has defined merchant banker as follows: any person, in your book I have written, who is engaged in the business of issue management, either by making arrangement regarding selling, buying, or subscribing. So, one function is issue management, where he will arrange for buying, selling, subscribing of security, or acting as a manager, consultant, or advisor. He can also act as manager, whole issue they will manage. Consultant about price and other things, advisor, or rendering corporate advisory services in relation to such issue management. So their activities involve issue management, manager, consultant, advisor, okay, and all such services in connection with issue of securities. In case of both the public issue and right issue, it is mandatory to appoint a merchant banker. Okay, is it mandatory? Yes. This question, I think, in one exam or in one MTP, they have asked model test paper that it is mandatory to appoint merchant banker. True or false? True. What is the task of merchant banker? Is basically that of a facilitator or a coordinator. Now the next is it coordinates the process of issue management because there are so many agencies involved. Okay, it's not an easy task coming out with an IP or a right issue. There are so many agencies, so many stakeholders, so many formalities, legal compliances. So they are the coordinators. They coordinate the process of issue management by helping the underwriter, registrars, and bankers in pricing and marketing the issue and complying with the SEBI guideline. All those legal functions they have to perform. But these merchant bankers have been prohibited from certain activities to protect the interest of the investor, to have a fair play. What are the activities they can't do? Merchant bankers are prohibited from carrying on certain activities such as acceptance of deposit, leasing, and bill discounting. Okay, because there might be conflict of interest involved in such cases. Then they are not allowed to borrow any money from the market. And the third is they are also debarred from engaging in the acquisition and sale of securities on a commercial basis. So merchant banker is a different class of service provider. They are not broker. They are not brokers. They are not borrower or lender. They only provide services relating to issue management. You need funds, they will arrange for it. So that is merchant banker. Please also read some other chapter where we have covered merchant bankers. Next is registrar to an issue and share transfer agent. Now, this again will divide into two paragraphs. First, registrar, first point A, B, C, D, and last 4 points deals with share transfer agent. So basically, these are like more uh, clerical tasks they complete. Okay, maintenance of records of investors, dispatch of share certificate, allotment letter, etc. So registrar, like in colleges, we used to have registrar. Yes or no? And I always used to wonder how can a person do such a boring job. Anyway, that is his problem. And they were always in a negative mood only. Yes or no? Any experience with registrar of a college? No, never went. If you have not gone, that is even good, better. Registrar to an issue means a person who is involved with the following activity: collecting application on behalf of investor. What is the fun in that? And keep a proper record of monies received and paid. Okay. Then helping the company which has issued share. This is good. They sit down with the companies and determine the basis of allotment of securities in consultation with the stock exchange. Especially if there is an oversubscription, that time they have to play an important role in deciding to whom the share should be allotted, keeping in mind the SEBI regulation, Companies Act, etc. It's not very simple the way it is taught in 11th, 12th accounts because there are categories of investor: retail investor, employees, qualified institutional buyers, and there are quotas for these investors. Okay, so all these things they have to take care while doing the allotment. And then finally making a list of person entitled to the allotment of securities. So this is the function of registrar. And after that list is finalized, processing and dispatch of allotment letters, share certificate, and refund orders. Wherever electronic transfers are possible, these all transactions will be done in electronic mode. Like nowadays, they don't send share certificate, but your demat account will be credited with so many number of shares, or they don't send you refund order, the amount is transferred to your bank account. If you have taken an ASBA facility, then that amount will be unlocked. Okay, even the allotment information nowadays is sent on your email account. Then who are the share transfer agents? Share transfer agent means a person, again more clerical task, who on behalf of the issuer company maintains the records of the holder of security issued by such company. So their task is to continuously update the record of shareholder. Okay, the registrar to an issue and share transfer agents are important intermediaries in the primary market, because there are lakhs of people who invest in the company's share. There must be somebody who will keep a record of all these shareholders, send them allotment later, refund the money, etc. etc. So all this task is assigned to an agency called registrar and share transfer agent. They help in mobilizing the new capital. They ensure that proper records of details of investors are maintained, so that the decisions regarding basis for allotment and the number of securities to be allotted can be smoothly implemented. So they will keep a record of all the applications received. Okay, because lakhs of people apply. Task is very challenging. Not just 10-15 people like in your 12th standard exam they used to give. Okay, lakhs of people apply, and then to whom you should allot, you have to sit down and decide. Therefore, these agencies are also important. And this is your favorite intermediate accounts chapter, underwriters. Who are the underwriters? Underwriter in general means anybody who protects you from the risk, underwrites your risk. In case of companies which is coming out with a public issue, there is a serious risk involved, and that risk is that your issue may be undersubscribed. Your issue may be unless you're a very reputed company, there is a risk that issue may be undersubscribed, because people may not have faith in you, confidence in you, they may not know you. Why will they invest in the equity share of your company? Don't they have some better option to invest their money? So who brings the investors on the table? The underwriter. Now these are specialized agencies. They know how to market the issue, how to approach the investor. And underwriters may be known companies, so investors have confidence in underwriter. And if an underwriter is promoting an issue, then he will have some faith in the company also. It is like selling a product. You will hire a brand ambassador, okay? So if Amitabh Bachchan is endorsing the product, we tend to buy, or at least we have some motivation to buy. But if without any well-known face, acceptable face, confident face, are you going to buy the product? Chances are less. It's only the probability which goes up when you associate an underwriter with an issue or a product with a brand endorser. Okay. So that is the reason underwriters are appointed, and he also gives an assurance to the company that if people don't subscribe, we will subscribe. So what the promoters can do now, they can focus on their business. They will not be worried about the fate of the issue, because they know that there is an underwriter and we are going to get that minimum subscription. Our project will not be stalled, we'll get the money and we can go ahead. So they can concentrate on their project execution task. Okay. So what is an underwriter, or who is an underwriter? A person who engages in the business of underwriting the public issue of security of a particular company. An underwriting is an arrangement in which a SEBI registered underwriter, all these persons whose name have come in paragraph 3 are to compulsorily register with SEBI, gives an undertaking to the issuing company that in case the company's public issue is not fully subscribed, the underwriter will purchase the unsubscribed portion of the public issue. Underwriting is compulsory for a public. Now it is compulsory also. So therefore, the chances that an issue will fail is very, very negligible. It is necessary for a public company which invites public subscription. Now this is Companies Act provision to ensure that 90% of the issue is fully subscribed. Otherwise, the whole amount has to be refunded. Why this provision of refund is there? Because with less than 90%, you will not be able to successfully execute the project also. So project may be stopped in between. Let us suppose you want to construct this highway which requires 100 crore and you get only 60 crore, 80 crore. You can't complete the highway. So even that 80 crore money will get blocked. Don't take it all. Refund it. But 90% means okay, somehow you'll be able to manage the remaining 10%. So that is why the benchmark is very high here. Okay. The company cannot fully rely on the advertisement to ensure full subscription. Only advertising your issue on the back of a auto bus, hoardings, okay, is not enough. You need somebody who will back up this issue, and that is by underwriter. In case of any under subscription, it has to be made good by the underwriter. The underwriting agreement has to be made in advance of the opening of the public issue. Of course, why this line was required? Can we enter into an underwriting agreement after the public issue is made? Next paragraph, bankers to an issue. In this chapter, they have written little briefly because I think we have covered this in detail in one earlier chapter. Okay, I think chapter 2 or 3, just check. Next is bankers to an issue. One of the important intermediaries in the whole process is bankers. You have to make an application, bank. Company will allot the shares and in case of non-allotment refund, bank. Okay, lakhs of people from different parts of the country are making applications. The bank is required. So banker to an issue means a scheduled bank who is going to perform the following task: acceptance of application money. In case where the total amount is received in installment, application, allotment, call, they will also be responsible for taking the allotment or call money. In case of excess application, oversubscription, refund of application money. Once the shares are allotted, later on, whenever the company has to pay dividend, interest, then they make payment of interest or dividend. So this is their role. Bankers to the issue carries out the important task of ensuring that funds are collected and transferred to the escrow account till the application allotment is made. Till the allotment is made, you can't use that money. You have to keep it in that escrow account. Escrow are created for specific purpose. And after the allotment, then the company can use this money. The banks do a great favor to the company in mobilization of capital. So without efficient banking system, even the application money, allotment money, call money, etc. cannot be collected properly on time. Next is debenture trustee. The role of debenture trustee will come only if the company is raising funds by issue of debentures. Lakhs of debenture holders are there. Somebody subscribe for 1,000 rupees, somebody 1 lakh, 10,000. Individually, they can't fight with the company. Yes or no? If you have subscribed for 10,000 and if you don't receive interest, will you go and file a case against the company? Chances are less. Because for 1,000 rupees interest which you have not received, your lawyer will charge you 5,000 rupees for initial drafting of the case. Then for attending one hearing, another 5,000 rupees bill he will raise. If he is a local lawyer. If it is Ram Jethmalani, for every one hearing, he will raise a bill of 25 lakh rupees. Okay. So better you lose 10,000 and be happy. But then if this way, there are many investor company will be motivated to cheat because he knows that individually they can't come and fight against us. So to protect the interest of the investor, there is a body, person who is given a lot of power. Okay, on behalf of the investor, it will fight against the company, and that fellow is called debenture trustee, which can be an entity also. So a debenture trust deed. In case of debenture, you have to prepare a document called debenture trust deed, which will list down all terms and conditions relating to that issue. Is a document created by the company where debenture trustees are appointed. So as per the law in India, you have to appoint a debenture trustee, and the main function of this debenture trustee is to protect the interest of the debenture holders, like timely payment of interest, repayment, security. Okay. To act as a debenture trustee, what is the qualification or condition? Entity should be either a scheduled bank carrying on commercial activity, or a public financial institution, or an insurance company, or a body corporate. So these people can act as debenture trustee, and they have to be registered with SEBI. The contract deed entered into with the debenture trustee must specify the interest rate and the date of interest and principal repayment. So what they will ensure then, in future, company pays interest and principal as per the agreement. Now in your notes, there is a long list of duties of debenture trustees given, A, B, C, D till H. Okay. So we'll read it, understand. Call for periodical reports from the body corporate. That means from time to time they can ask for certain reports from the company which has issued the debenture. Then take possession of trust property in accordance with the provisions of trust deed. If the company does not repay, then those assets which are given as security can be used by the debenture trustee to repay the debenture holders. So that is points B and C. Enforce security in the interest of the debenture holder. And point number D, little bigger point, ensure on a continuous basis. What is his duty? Every periodically, that property charged to the debenture is available and adequate at all times, because most of the debentures are secured. You have given some security. So it should be adequate and it should be available to discharge the interest and principal amount payable in respect of the debenture. And that such property is free from any other encumbrances. You can't use the same property again as a collateral except those which are specifically agreed with the debenture trust. So if already there is an agreement, then it is okay, but later you can't use the property again for collateral. 5. Exercise due diligence to ensure compliance by the body corporate with the provisions of the Companies Act, the listing agreement of the stock exchange, or the trust. So their duty is to conduct due diligence. Company should comply with Companies Act, company should comply with the listing agreement, and company should comply with the trust deed to take appropriate measures for protecting the interest of the debenture holders as soon as any breach of trust deed or law comes to his notice. Whenever any breach of trust deed will take place, whatever action is required according to situation, he will have to take that action. To ascertain that the debentures have been converted or redeemed in accordance with the provisions and conditions under which they are offered to the debenture holder. So that is an important task. Redemption, conversion, interest payment, are taking place as per the debenture trust deed, and inform the board. Who is the board? SEBI, Securities and Exchange Board, immediately of any breach of trust deed or provision of any law. The moment they think something is going wrong, fishy, inform SEBI. Then the SEBI will appoint a SEBI will do whatever is required. Last function is I. Appoint a nominee director on the board of the body corporate when required. So debenture trustee also have the power to appoint the nominee directors, representative directors. So even they can participate in board meeting and influence the board decisions in the overall interest of the debenture holder. Now your favorite topic, portfolio. Okay. Who is a portfolio manager? The one who manages the portfolio on behalf of his client. But SEBI has its own style of defining. Okay. So SEBI says a portfolio manager is a body corporate who, pursuant to a contract or arrangement with a client, advises or directs or undertakes on behalf of the client, whether as a discretionary portfolio manager or otherwise. Discretionary means he can take decision on his own without every time consulting the client. Non-discretionary means he has to first take the approval of the client before he buys, sells, or does any activity. The management or administration of a portfolio of securities or the funds of the client. He is a portfolio manager. So simplified version is that is he manages portfolio on behalf of the client. He can be a discretionary or a non-discretionary fund manager. He manages the security, he manages the funds. Okay. Now, what is a general definition of portfolio manager in your SFM batch? A portfolio manager is a person who is responsible for investing a fund's asset, monitoring investment strategy, and doing day-to-day trading. So, this is the normal job of a portfolio manager. Now, suppose you are Virat Kohli, VK, not me. VK stands for Virat Kohli. Vinod Kumar also. That's very ordinary person. So Virat Kohli has lot of money, including Anushka's money. So what he will do? Will he manage his portfolio on his own? Does he have the time? No. Most of the time goes in cricket, practice, and if some time permits, then brand endorsement. Okay. Chocolate, biscuit, everything. Where will he get time to read the balance sheet, annual report, and other things? So he will hire you in future when you start your portfolio management company, and then you have to invest his fund, monitor the investment strategy, and you have to also buy and sell on a regular basis. If you think this share will not perform, sell, buy, these activities you do. This is one of the growing businesses in India because in general income of people are increasing, salaries have increased in many sectors, but people do not have any skill in managing their investments. They don't know what is mutual fund. Simple thing. For you it may look simple, but for many people they don't understand what is mutual. What they only know is the nearby bank where they can go and park their deposit on which they get 7%, pay 30% tax on that, hardly they are left with anything. Or they can go to some bank post office and buy that NSC certificate. That's it. But there are other avenues also which needs to be informed. And therefore in India there are many portfolio management services which have grown up to cater to needs of people who have money but do not have the time or the energy or the skill to do the portfolio management. Okay. So portfolio manager manages mutual fund and other investment funds such as hedge fund or venture fund also. This investment fund, hedge fund, venture fund, we'll discuss later. He may be an experienced investor who can become a good portfolio manager, person with experience in the field of investment, like you, a broker, a fund manager, or a trader with good knowledge of industry and having a track record of producing good results. This, of course, demands a lot of efforts to become a good portfolio manager. It's not an easy task because you have to understand how the stock market, security market, okay, money market works. When the prices go up, comes down, what is the right time to buy or sell? How a policy decision of the government or a company, okay, or any news can affect the stock market at a point of time, and then you have to quickly take the decisions. So the portfolio manager provides to the client the disclosure document at least 2 days prior to entering into an agreement with the client. So he will disclose terms and condition to the client. They come with a very bulky document which says these are the terms and conditions. Go through it, sign it, and give it to us after 2-3 days, so that you know what you can expect from the portfolio manager. What he includes in his disclosure document: the quantum and the manner of payment of fees payable by the client for each activity. What will be the services he will provide? How much fees he will charge? How the fees will be charged? Then he will explain you the risk of your portfolio. They will tell you whether it is a high risk portfolio, medium risk, low risk, moderate. According to the client, they will decide. Then they will complete disclosure in respect of transactions with related party. In case if there is a transaction with related party of that portfolio manager, you have to make a disclosure to the client. The performance of the portfolio manager you have to disclose, and the audited financial statement of portfolio manager for the immediately preceding 3 years. These are the documents you have to provide to the client so that he will decide to appoint you as a portfolio manager or not. And please note that a disclosure document is neither approved nor disapproved by the SEBI. So later you can't blame SEBI for anything goes wrong. Nor does SEBI certify the accuracy or adequacy of the contents of the document. So SEBI does not do audit of this disclosure. Most of these disclosure documents I have seen are in the form of a big advertisement only. They'll all make big and tall claims, okay? So it's better you verify independently, apply your own judgment, then appoint a portfolio manager. Okay? Now we'll continue tomorrow.